Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, who is a strategist at ADMISI. And well, happy anniversary, not to you, but to Black Monday, 30 years on. Now, what lessons have the markets learned, and are there any parallels with what happened on that fateful day 30 years ago?
Obviously, the constellation of events at that time were particularly against a very different monetary policy backdrop. You know, in rate terms, we had 4s and 5s in terms of central bank interest rates. In the UK, much higher than that. But what we did have at the time was a lot of tension brewing at that time. At the moment, it's more between the US and China, though there is another similarity between the US and Germany, as there was at the time. And there was a lot of market complacency. No one really believed that interest rates were going to rise very much. And the US was blaming Germany, this sounds very, very familiar, for having much too big a trade surplus and current account surplus, situation which we find ourselves back in again today. And they also were suggesting that one of the things which could be done on that front would be for the Bundesbank to loosen policy, and it was certainly not interested in doing that. But as I say, the real sort of memory of that time is that despite all these brewing tensions between the US and Germany, which were effectively the most influential economies at the time, along with Japan, Japan obviously just before it crashed completely, and we had the situation where stock markets were just going up and up and up, and in Japan particularly relentless. And suddenly we found ourselves in this situation where it started everything. We had a straw that broke the camel's back. The Bundesbank raised rates, and suddenly people went, okay, that's probably not particularly good news. And due to a constellation and the lack of what one would call some of the safety mechanisms that we have in financial markets nowadays, and at the time, obviously, we were in a much higher interest rate environment, and no one had ever thought about something called the Greenspan put, and that central banks would come to the rescue. So suddenly things tipped out. Market fell on the day about 22%. Everyone thought it was gloom and doom, but actually by the end of the year, obviously, we were actually up relative to that point. And I think perhaps that's the sort of situation which is worth remembering at the moment, because as much as we are looking at equity markets and thinking they're very, very overvalued, and that poses a risk of something being triggered here, something which is self-feeding, because I think the key element of what happened at the time was it suddenly just became everyone's stops went off, and then suddenly people were chasing the market down to try and liquidate their position, and there was no market liquidity. I think at the current backdrop, in those days, obviously there was much better liquidity.
Yes.
But nowadays, due to post-central bank, post-GFC regulation, liquidity isn't as good. So the risk of one of these self-feeding things, which in the longer run may prove to be nothing more than a blip, is still actually quite high. So we actually haven't, to a certain extent, we never quite mitigate those risks, and we probably never will be able to.
I mean, one of my fears, I'm not saying we're going to have a crash, and a lot of people, a lot of commentators saying there's high potential for that to happen. I personally don't think that's the case, but one of my biggest fears is if we do see a sudden sell-off, how the markets will react. And I know there are now checks and balances in place to halt markets, tick up rules, etc., can be in place. But in a world now where, as you've already mentioned, liquidity from the major banks has gone, the lender of last resorts are there, and they've been printing and supporting the markets for the best part of a decade. The problem is now is finding a buyer when everyone's fleeing the dance floor in a herd mentality. And with algorithms and leverage now more apparent in the market, if it does happen, will potentially have a bigger impact than it did 30 years ago?
It could do, in the sense that we also know that probably one of the most popular trades out there from some of the popular leverage trades is the short volatility trade. As we know, the VIX index is basically just gets lower and lower and lower, and people look at it and say, surely it can't get any lower. But then when you look at it relative to realized volatility and realize that actually the VIX is higher than what people are actually realizing in volatility terms, you then go, right, well, the primary risk here is an old-fashioned one in financial markets, that someone is basically chasing an ever smaller return with an ever larger and more leveraged position. And that's where the big risk lies, because you get to that situation, and this is really where markets always fall flat on their faces time and time and time again. You can't really legislate for it unless people are slightly more careful in risk monitoring. But you get to this position where someone gets caught the wrong side of it. They then try and liquidate that position. It triggers that they then have the position liquidated, but they now have a huge loss on their book. And then someone else comes along and says, well, that has to be paid for by liquidating those assets which have been performing well. And that's where it becomes self-feeding, and that's where the biggest danger lies, that someone actually has a big loss, and they have to start liquidating good assets, and that's where the thing starts to tumble down on itself. It will, in the long run, eventually stabilize, but you'd have to say, with liquidity conditions being where they were, banks not entertaining the sort of proprietary books that they did, in fact, barely any.
Yes.
Who is going to stand in the way of the fall? Before, there were you always had what people called the plunge protection team. Nowadays, that plunge protection team would probably stand out of the way. So you'd probably be waiting for the good old central bank to come in and buy. But at that stage, you then start to worry, well, the only reason we can keep these markets up is if central banks start buying equities. That, I think, would be a very poor signal, even though you've got some central banks like the Swiss National Bank and the Bank of Japan already buying equities as part of their quantitative easing.
Understood. Well, fingers crossed it doesn't happen, but as I say, on the 30th anniversary, Mark, thank you very much for joining us today.